we'll deal. It'd been quite a marathon to get to closing. And so we're like, all right, we'll just deal with it. Next week we'll get forced place insurance. We'll reach out to the buyer borrower. It's probably just a little fluke. And that property burned down. No insurance. And I didn't have a forced place policy then implemented. I didn't have backup on that. And so that servicer didn't have it on their accounts. And so, wow, did I learn that lesson well? And that I won't go into all the details. It is on our noteinvestor.com site. I walk through what happened and what I learned and what I could have done better. And you think that might have been a fluke, but a couple of years later, we got to closing. We had the same situation and we stopped the funding, and that house actually burned down over the weekend. And we were so glad that we had stuck to our guns.
Hi, welcome to Priority Investor Conversations. I'm your host, David Garner, and this is the show where we talk about everything passive investing in real estate. We talk about note investing, private lending, syndications, rental properties, and almost everything else you can think of. And we have some amazing guests with some great experience and stories to share. So enjoy the show. So, Tracy, thanks for joining us. Why don't you tell our audience a little bit about who you are and what it is you do?
Well, I am excited about note investing, and obviously because I still am doing it after 3 decades. So I better still like it, right?
Yeah, for sure.
So when you know something so long, you get to know it well. And if you're still doing it, if you're still married to it, you are still loving it. So fortunately, I still love note investing. And I started back in 1988, and I came at it from a different perspective because I was working for a large institutional investor that specialized in buying seller finance notes and eventually turning them into securities. And so I learned it from the perspective of a big investor. And I did that for 10 years. I loved it. I learned so much, and I got to learn on their dime, but I couldn't buy notes for myself because that's a conflict of interest. So I was buying real estate using owner financing and renting it out. And I quickly realized I did not want to be the landlord. I wanted to be the lien lord. I liked being the bank. I like that. Yeah, I liked being the bank way better than the tenants, toilets, and trash. So
I'm stealing that. Lien lord.
So I decided to start, after 10 years of that, a great education, co-founded a note investing company, a private note investing company with my husband. And so we have had that, and we started noteinvestor.com, which is like an online newsletter for note investors. And we've been doing that on our own now for 20 years. So you add that all up together, it's 30 years. I still love the note investing business. I still love the seller financing niche. And I'm excited to be on this podcast today to talk about the mistakes that people make sometimes in the note business. And I've made some of them myself. So those are the ones we learn the best.
I tend to find that mistakes are the richest source of information that you will have in any business. Making mistakes is where you learn. Unfortunately, in the world of investing, that often means it costs you money. Mistakes will cost you time or money. So not ideal, but I've been through the mill myself with notes and with real estate. I've made a ton of mistakes. Fortunately, they haven't been financially devastating, but I have been able to learn really valuable lessons and not repeat the same thing twice. Because the thing is, you can make a mistake and get away with it. So you'll make the same mistake again until you don't get away with it. And then it's a problem, right? And then it's cost you money. And then you figure out how to not make the mistake again. That tends to be the process. And in the note investing world, from what I see, like I don't buy a lot of notes now. I bought my first notes. I wouldn't say similar to you, but there's certainly some parallels with the story. In 2010, there were lots of non-performing notes around in 2010. I was raising capital for some guys out of New York, and they came to me and said, hey, we have an opportunity to buy these non-performing notes. I didn't even know what the terminology meant. Do you want in on it? We need a team member that's capable of speaking to the borrowers and trying to work out deals with them. And I was like, I have no idea what I'm doing, but yes, sounds great. We'll do it. Because we were buying $10 million worth of loans for $1 million. So I'm like, there's enough margin in there for me to get this really wrong and still make a profit, surely. So that was my first introduction to it. And I kind of had to learn on the job as well, but I was surrounded by people who knew that game at the institutional level. So there were some really valuable lessons for me there. But I didn't go out and sort of buy personally notes from private sellers or brokers or anything like that for some time afterwards. But I obviously made a bunch of mistakes doing that because I didn't know what the heck I was doing. But I've been putting some thought into this when we kind of went back and forth on email and tried to figure out what we were going to talk about that's going to be valuable. And I had Jamie Bateman on last week of Labrador Lending. Jamie's a great guy. I know you guys know each other.
He is a great guy. He spoke at our Cash Flow Expo. He did a nice job. Yeah. Yeah,
he's fantastic. Jamie's brilliant. And we had a great conversation about mindset for note investors. And it's not something everyone talks about, you know, the checklists and the basics and the, you know, the technicals, but there's a certain amount of mindset and personality traits that lend themselves to success in this particular niche. So I wanted that got me thinking to this conversation. And I think one of the biggest mistakes people make before anything else is having the wrong expectations when they get into it. And really that's no fault of anybody's, but there's a lot of folk out there, as you well know, being in sort of the note education business or the note investor education business, there's a lot of people out there telling people that they're going to get rich quick. And it's kind of the opposite. It's a very slow, laborious process. It's methodical. There are lots of different skills that you need, and there's a lot of knowledge that you need. But I think from my experience of speaking, I speak to a lot of investors that are initially interested in notes, because my job is kind of to convert them into, you know, an interest in my investment program, which is sometimes successful, sometimes not. But the expectations that a lot of these guys have is we're gonna instantly find the big hitter. We're going to instantly find that non-performing note that we can buy for 10 cents on the dollar, and we're going to either work out through the borrower, or we're going to foreclose and own a $100,000 piece of real estate, and we're going to be rich, and then we're going to do that 10 more times and retire. And so for me, I think that's a good starting point for us. I think people have a misconstrued sense of the amount of time it's going to take to do this properly and the kind of returns that you're likely to make in the short term. So that's I think that's my number one at the very, very least.
I think that is a great number one. And look, people say things because they want it to sell. And I guess it doesn't sell for them to say, you know, get solid returns backed by real estate over the next 20 years, you know, get profitable slow. Maybe I guess that's why they don't say that.
Get rich slow. I like it.
So I agree with that. I come from it a little differently because we've always played in the performing first position space. So that has tended to be a longer play. We still buy those notes at a discount, and sometimes we'll get to see a payoff early. So we'll get to realize all that discount, which is also a beautiful thing. But the non-performing note space by 10 cents on the dollar, that was definitely a change in the market, as you mentioned, after 2010, which now has, for the most part, dried up. I'm not saying there aren't non-performing notes. They are, but at 10 cents on the dollar, no, right?
If it's 10 cents on the dollar, in my experience, it means that it's already been through 10 guys that really know what they're doing who can't do anything with it. Either the title's so screwed up, or the house is such a mess that, or the borrower's such a problem that it's just, that's what it's worth. It's worth 10 cents on the dollar.
I would agree. And so that was an interesting glitch in the market, kind of like when you could go out and buy all these REO properties, right? Or you could get short sales. That was that glitch in the market. And so some people capitalized on it, as they should, because when there's a market change and a shift and you can make money at it, you should. But now I see us back to kind of what the market was for the other 20 years I was doing the business. And so we're looking at it more of is this a solid investment backed by real estate? And what are my returns? What are my exit strategies? And I do agree that there has been misinformation about how easy it is and how much money you can make. And so that's one of the things we try to do, right? With your educational platform and these kind of podcasts is just get real about what the expectations are. So that's a great place to start off.
Absolutely. And that kind of leads me into talk about noteinvestor.com. It's riddled with good quality education.
Thank you.
And I think that leads me on to my number 2, which is getting the right level of education and ideally mentoring if you can. And it is out there. But the one thing, as kind of, obviously, I'm not an American. So
no, that's not a Southern accent.
Yeah, no, it's not a Mississippi accent. So I tend to have a kind of departed, or a bit of what's the word, objectivity, I suppose, when I look at it's kind of a different perspective and viewpoint when I look at what goes on in the markets that I operate in. You know, I buy a lot of houses in America. I do a lot of private lending deals in the US with investors for our program. But one thing I was really surprised at when I, back in 2010 and afterwards, and we made those investments, we made good money out of it, because how can you not when you're buying notes that cheap? I started to educate myself, and the amount of money people spend on education for what can be found, I think, in far better value places is astonishing. It's astonishing, the tens upon tens upon tens of thousands of dollars that people can spend on education, that really a lot of the real good quality stuff is already out there in the public domain, or it's available at a reasonably pricing point, like with noteinvestor.com. You've got so much good quality content out there, but you're not asking people for like $25,000 for a weekend, right?
Right.
So, and I've spoken to a bunch of people that have attended those things. But how would you know any difference if you're saying, right, I want to educate myself to the highest possible level, and I really want to know what I'm doing. I'm going to spend as much money on it as possible, but that doesn't necessarily equate to value. So my number 2 is education and mentoring, but making sure that, ideally mentoring, you want to find somebody who's, and I tend to find that the note game is very similar to the real estate game. There are capable, successful investors out there that are more than happy to help you, and a lot of them have paid mentoring programs as well. So hop on the shoulder of somebody that's doing it already, or join a mastermind. Like you guys run masterminds. The information is held by people. So go find those people first. Very much like I always tell people, real estate's a people game. Bricks and mortar are just the symptom of it. It's all a people game.
Are you saying we have a sickness? Is that what you're saying?
Yeah, we're all addicted. We're all addicted.
All of us in the real estate and the note world. Yeah, we like the deal. We like the art of the deal.
Yeah, absolutely. Everybody does. It's the exciting part. It's the part that keeps us interested, right? So expectations and education for you. What, in your experience, what's the first piece of advice, or the first big mistake that you would say people make that should be avoided and could be avoided?
I would like to piggyback on the mentoring and the education side, because I have seen a trend where people are buying the notes from the person that's educating them.
Mm-hmm. Yeah.
That, or doing a partnership with them, and they don't know any better. And so it's like, I'll be like, you didn't get on title, you didn't get the original note, you didn't get an assignment. Oh no, we just had this agreement. It's like, okay, you don't really own a note. You just did an investment loosely with someone who really owns the note. So I think perhaps that leads us to one of those first big mistakes when you talk the technicality. They just don't know what it is to paper up, to document a note. So you've got to get familiar with what I call the 3 Ps, which are the people. And the people can be the people making payments, and it can also be the person selling you the note. Yeah. You have to get comfortable with the paperwork, because that's what's going to allow you to enforce it if the people don't make their payments. And then you got to get familiar with the property, evaluate the property, the 3rd P, because that's what you get back and using your paperwork if the people don't pay. So they don't understand the basics, like get the original note, make sure that if the holder seller of the note isn't on there from the beginning, that they have a proper change of allonges and endorsements and recorded assignments, and did you check title? And so we always come down to title, taxes, and insurance. Those are the 3 things, right, that normally get people in trouble, and that can lead us into some other stories. So I would just say, understand the basics and make sure that you get on title and what you're buying is enforceable.
Yeah, I think the golden rule there is just be wary of somebody that's selling you a concept as really, really profitable and then saying you can buy that from me. Because I've always thought that if it was that good, then you wouldn't want. But why? I don't understand why people promote their products in that way. Why not just say, hey, I've got a great investment and I need a capital partner for this. I've got all the technical skills and you're the silent partner. And that's, honest. But instead, it's kind of dressed up as this. You're going to be this amazing note investor and I'm going to train you how to do it. And you're going to make all these profits. But, I'm going to be the one that sells you the notes. And you wouldn't do that in any other sort of sphere of life. I don't think. It's an issue of overtrust, but most definitely there are high quality trainings out there. There are great people to work with out there. But I think as well, maybe this is another sort of caveat to the expectations point that I made earlier in terms of time. So don't expect to hop on this and become an expert straight away. Take enough time to really get to know people and get to know the industry, because there are people in the note industry. You only have to hop on like LinkedIn, and there are people that are, prominent, yourself included, right? And, you stick around long enough and you listen to what people say and you understand that people are adding value rather than always constantly taking, which is something I've noticed that you do on, say, for example, LinkedIn. You're constantly adding more value for people. Hey, here's some free information. Here's some educational materials that might help you out. And ultimately, those that are then serious will find their way to you, right? You lead with adding value, which is something I talked about with Jamie as well, which is a great piece of advice that I took away from my conversation with him. But yeah, it's really difficult because you don't know until you know, right? You're interested in notes, you end up on somebody's list, they pitch you something. Why would you disbelieve them? But it's back to that trust and verify, isn't it? Which is part of your note investing due diligence process. If you're dealing with a seller, you can trust what they're saying, but I'm sure as hell going to verify it.
Absolutely.
And then learning how to do that, and you've got to do that with people as well. Like I've got a guy at the moment that we're hopefully going to do some business with in our private lending program. He's a new investor. He's done some private lending before, but he wants kind of low risk stuff, which are kind of rehabbed and rented bridge loans are great. They fit with what he wants to do, but he's kind of nervous because he doesn't know me. So he's asked to speak to a couple of existing lenders. Great. He's, got all of our company registration details. Fantastic. He's looked on the county records to see what we've owned, what we've bought, what we've sold. And I'm like, this is fantastic. This is it. And I'm learning as I'm going along with this guy, because I'm like, I need to have this ready for the next person that asks. So it helps my business to evolve as well. I'm dealing with those kind of people. But that level of checks and balances is something where I've failed before. I've trusted the wrong people, and it's cost me very, very dearly, financially, psychologically, emotionally, on all kind of levels. So trust then verify is a great tip, I think, and find good people to work with and make a start somewhere, right? You've got to make a start somewhere, but you don't necessarily have to make a $25,000 for a weekend start. Yeah. There are plenty of better value entry points, I think.
And some people like that. They feel like they're getting a higher level. We approached our training and mentorship in a way that it would be something we would have bought when we were starting out. So that's both in the training and then the access and in the, the live support and also the affordability, because, people say, well, I paid $20,000. I'm like, I can find you a note to buy for $20,000. Now, we don't sell notes to our people that we mentor and train, but we do help them find notes or help them market or share our wisdom from what works for us. And I think that might lead to another mistake that people make is they think that these notes are just going to appear. And you've got to market. You've got to spend time on marketing. The note business is like all businesses. You live and die by marketing.
Yes.
And so plan on knowing how you're going to market. Are you going to be a networker? Are you going to market direct? Are you going to buy at retail prices? Or are you going to want to do wholesale deals? Because that works similar to what we see in real estate business. It transcends over into the note business where you want to be in that market. and where you want your returns and your investment levels. So you've got to have a marketing plan, and you're going to have to either spend time or dollars. Fortunately, you can pick one or the other, or you can do a combination of both, but it's going to be time or money to be able to market.
Yeah, absolutely. Yeah. And again, that's another expectation that people wouldn't necessarily know going into it. They might think, well, I want to buy mortgage notes. I just need to know what kind of note suits me. Well, no, you need to know where to find them as well. And the evolution of websites like PaperStack and places like that have really opened up the market and connected buyers and sellers in a great way. I spoke to Brett Berkey the other day for this podcast, and we talked about how PaperStack's evolved with its escrow and audit as well. So they kind of, they can't wave a magic wand, but they've put a process together that didn't really exist before. It's a lot easier now to find notes for sale. I'm not saying they're any good, right? You've still got to figure out whether what you're buying is worth what you're paying or worth what you think it's worth. But it's a lot easier today to find notes. But certainly if you want to find those seller finance notes that people are holding, they might just be sat in somebody's retirement account, and they're not thinking about selling it because they don't know that they can. It's until you put yourself in front of those buyers, like when we buy off-market properties. A lot of these people were thinking, I'm just going to lose my house. So we swing in and we say, well, that's not necessarily the case. Maybe we can do a better deal and you can walk away with some cash in your hand, or, maybe even stay in the home. But until you get in front of these people and have those conversations, they didn't necessarily know that. And it's the same with notes. I've found, there's some real great notes sat with people who aren't even thinking about selling them. So you've got to find the people first, and then you'll find the notes, right?
Yeah, that's right.
Okay. So what else have we got? I think point number 3 that I've scribbled down on my gross little pad is having too rigid a plan is a mistake that I hear from people a lot, because they do a lot of reading and they figure out, what the different workouts might be for notes. You might work out through the borrower, you might work out through the real estate. There's a ton of different things that can happen, right? And they're like, right, I'm gonna just foreclose on everything. You're like, So, and you can sort of set your due diligence process up to buy notes that looks like the potential for it. But ultimately, what I found when I was first sort of dumped in that seat at that phone calling borrowers, I figured out very quickly that the first thing you do is ask the borrower what they want to do, right? Rather than just blindly think, okay, I'm going to do this. The first thing you do, you might have a grand plan for a note because you've done all of your numbers and you go, this looks like I can modify this loan and we can do this and it'll be great and lovely. And then you pick up the phone and you just can't get hold of them because they're absentee, or they don't want to do the deal that you thought would be a great deal for them. So being able to pivot and not have such a rigid plan, just have plenty of tools in your toolbox that you can pull out based on the circumstances that you're presented with when you actually make that connection with the borrower. Because I don't know about you and I don't know what your process is, but for me, I figured out that was the easiest thing to do. I spent a lot of time reading collateral files and trying to figure out what my approach was going to be. And the guy sat next to me literally said, just pick up the phone and to try and speak to the borrower and ask them what do they want to do, and then see if you can build a deal around that and work from there. And who knows what that person's going to say? They're not paying their mortgage, so they've got problems, right? They might not even want to have that conversation, and that might take a lot longer than you think just to get in touch with them. Or they might have gone through a modification process up to the point where some lawyers got involved that they didn't like, and then they just stopped picking up the phone. So you've got to then be the person that reinvigorates that conversation. So you've got to have I think what I've scribbled down is rigid plan. And what I mean by that is having too fixed an approach. You've got to be very open-minded and just be happy to take what is most appropriate to do.
You have to be flexible and fluid if you want to be a note investor.
Yeah.
You cannot know everything that's going to happen in the market. You can't know everything that's going to happen in the life of that payor. I mean, we buy notes that are performing and do all our verification and due diligence, and then something might befall that person that was normally a good payer. COVID, for example, or an illness of a different kind of illness, or a death in the family, or you just don't know, or they might have to move across country. So there's all different things that happen. And so you need to be flexible and fluid. And the way that you do that as a note investor and stay successful at it is you go through all your exit strategies and you think of all the what ifs, and you make sure that you can at least come out whole, even if the worst what if happens. And then you have different levels of profit if the better what ifs happen. And then remember that we are in a people business to serve. And so people, if you get to know me, I don't just say that. I mean that. I mean, we're serving the seller who needs to sell the note because they have a problem they need to fix. We're serving the buyer because maybe they couldn't have bought a home through other ways and seller financing worked for them. Maybe we're serving the buyer because they got into a problem. We're going to help them fix it. And sometimes them giving us a deed in lieu and getting some cash to move on is solving their problem the best way possible. So we can solve problems, be flexible, be fluid, and still make a profit. And, I've been doing it for 30 years. And so, yeah, you're right. You don't always know what's going to happen. You just have to stay in the moment and do the best thing in that situation.
Absolutely. And that was actually where my business changed. I had a bunch of houses, rentals in kind of rough neighborhoods, C-class real estate, and had all of the problems that you have with those kind of houses. We had problem tenants and old houses, and the big repair bills and late rents and no rents and big turnover costs and all that stuff. And I sat down with my wife and I was like, look, this is not much fun. we've got like 25 of these houses. I'd sold a few, so we got like 25 of them. And actually, I ended up with them because I'd loaned someone some money and had to take the houses back because they didn't do what they said they were going to do. So I ended up with these houses. They were in very poor condition in a very rough neighborhood. And we sat down, and my wife is very, very clever. She spent 11 years in corporate in organizational development. So coaching leaders how to be better leaders, and working with really big business. So she got me to focus on where my problem was. And my problem really was focused on the tenant, because the tenant is the source of my income and they're looking after my asset. So I had to start looking at how I could serve the tenant better, because in that C-class space, the problem I found was that people treat the houses like crap because they've been treated like crap by slum landlords for so long, because that asset class and market segment is treated like a cash cow. They buy the house, they don't repair it, they take the rent, they sell the house for what they bought it for. And that's generally the cycle. And then these tenants get stuck in a series of under-maintained houses with crappy landlords. And so why wouldn't you treat the place like crap? Why would you bother paying your rent on time? So what we found is, how do we solve the problems of the tenant? Because if we can solve their problem, our problems get solved. So how do we serve those guys? So we created our Pathway to Home Ownership program, where we were like, okay, buy the house from us with your rent check. Instead of rent, we'll call it a mortgage payment. We'll figure out the details later, because I didn't really understand what I was doing. I was kind of doing seller financing. But, every rent check.
I know what you're doing.
Yeah, you did. But we just kind of sat there and we thought, well, this is, number one, they've got to put some money into it. So that all of a sudden they've got a financial interest. And number two, they have a vested interest in paying on time, because they get a bunch of benefits if they pay on time. Like, we strike off a little bit of the purchase price for them out of every rent check that they pay on time. They have to look after the house themselves, and it changes people's mindset a little bit. We fix up the house, we make it nice, so they're not going to have to pay for a new roof or a furnace or HVAC themselves. And then we give them an opportunity. We serve them with that opportunity, and it absolutely fundamentally changed how we do business. It changed our cash flow statements substantially, and it changed our balance sheet as well.
And you liked what you were doing again.
Yeah, absolutely. It's great. And it only worked out like 50% of the time, because people still have difficult lives, especially in that market space.
Yeah.
But those times that it did work out, it's amazing. Like, we sold a house a couple of weeks ago to a lady. She'd been looking in this neighborhood where a lot of investors buy for cash flow for 6 months for a house for her family. And the only houses needed, They're $100,000 houses. They all need $20,000 to $30,000 spending on them. So she just couldn't buy anything. There's just nothing available for her to buy. So we buy one of the houses, we renovate it, and now she saw it on the day we listed it, put her deposit down, and now she's living in it with her family and on a rent to own program, because she's probably not bankable just yet, but we're working with her to get her to be bankable. And that's an amazing feeling. And it's
a great feeling. You really helped her and you made a profit. It's why I love owner financing, because I know we both share this passion of affordable home ownership. And that is a problem in the United States. I know, especially you can talk to your market. I know you also invest in the United States, but you know, the average income cannot afford the average home price. And that's just getting worse as real estate appreciates. I'm happy real estate's appreciating, but we have a real affordable home ownership problem. And so seller financing serves that market very well, because the banks can't afford to make any money in those markets by lending to a lot of them because of the restrictions that were put on by the CFPB after the Dodd-Frank Act. So the seller financing fills that gap. I mean, if people think, oh, seller financing, nobody does it in this market. Well, and we track the stats we have for decades. And last year was 23.5 billion with a B was seller financed. And, you know, I just got a sneak peek at the numbers that we'll be publishing for last year, and it went up. Believe it or not, it went up in the midst of all of this crazy real estate market where you think everybody's paying cash and $70,000 over asking price. So you can make money in all markets. And yeah, you do get a good feeling when you help somebody go from being a renter to a homeowner. And that's a great thing. And they make a better payer than a tenant. No, hands down.
Absolutely. 100%. They pay on time. Because if they don't, you know, they've got a lot at stake.
Yeah, they have emotional equity. Yeah,
they have emotional equity. Yeah, absolutely, absolutely. And it I can tell you firsthand. We're at the moment we're putting about 2 to 3 on the market per month on our Pathway to Home Ownership program, and the last 3 months, everything that we've put out there is sold within a couple of days of listing. Yeah, for full appraised value. You know,
are you using Facebook Marketplace, or are you putting them on the MLS?
We're just putting them on the MLS.
Yeah.
Just we put our program's evolved a little bit, because I initially started saying, hey, I've got this great solution for this demographic and it's going to be brilliant, and started marketing our rent to own program. And what I found was they're not looking for it, because they don't believe that they can buy a house. A lot of them are like, well, I rent. I could never buy a home. So, and also it meant that we were kind of taking a chance on someone, and it's quite difficult to sit someone in a car and say, right, we've got that house there, or that house there, or that house there. Which one do you want to buy? Because then people get into the mindset of, well, I don't quite like this fence, or I don't like. Instead, what we do now is we try, although we're selling them on our rent to own pretty quickly now anyway. But what we try and do is put the tenant in there on a 6 month, at least a 6 month long-term tenancy first. And if they pay their bills on time and they're not a problem for 6 months, then we'll sit with them and say, hey, this house you're sat in, you've been living in for 6 months, do you want to buy it? And we'll help you do so. And that's way easier than sitting with someone in a car and driving around streets and getting them to choose a house. And we already have an existing relationship with them. It's a lot easier to do that deal. So, you know, how we do that has evolved a little bit as well, because we wanted to improve that 50% rate. We wanted more of them to stick, more of those deals to stick, and they do now. We're getting better at it, better at finding the right kind of tenants. But again, in the note game, I think circling all the way back to your point, it is a people game. It's most definitely about serving and leading with adding value. Like you say, you're adding value to the sellers, you're adding value to buyers. Your whole business really is. The whole noteinvestor.com principle is about adding value, because you're providing education, right? And that's probably the most valuable thing for anybody getting into the note investing game. So you're kind of adding value left, right, and center, which is great. What else do you think? What's a common mistake that you see people make? I've got 4 on my list. I've got one more, but I'm keen to hear what your next one is.
I think think for me, it usually comes down and the places people have brought me problems asking how to solve them, or mistakes I made myself when I went from a corporate mindset to a individual private investor mindset, is chances I might have taken when I was buying $20 million a month for the corporation are not the chances I can afford to take as a private investor, because I can't play the odds game. Everything matters more when it's your own private investor money. And so I think you really got to understand the taxes and title and insurance. And probably one of my biggest lessons and mistakes I made when I went from corporate to buying for myself. I'd been buying for myself about 2 years, keeping in mind I had 10 years experience already for the corporate side. And I had this property that we were getting ready to buy the note, and we had verified it was insured for fire and hazard. We got to the closing table, and we found out that while we had a copy of the deck page, were making their monthly premiums. It wasn't escrowed, so they were paying it monthly.
Right.
And that they had missed a payment, and so it wasn't technically in force. And so I should have pulled funds from the closing table and said, figure that out.
Yeah.
And then, but they were sitting there at closing at the title company, and we're like, okay, we'll deal. It'd been quite a marathon to get to closing. And so we're like, all right, we'll just deal with it. Next week we'll get forced place insurance. We'll reach out to the borrower. It's probably just a little fluke. And that property burned down. No insurance. And I didn't have a forced place policy then implemented. I didn't have backup on that. And so that servicer didn't have it on their accounts. And so, wow, did I learn that lesson well? And that I won't go into all the details. It is on our noteinvestor.com site. I walk through what happened and what I learned and what I could have done better. And you think that might have been a fluke, but a couple of years later, we got to closing. We had the same situation, and we stopped the funding, and that house actually burned down over the weekend. And we were so glad that we had stuck to our guns. So that's just one small piece. I don't say that to scare people. We worked our way out of it. I mean, we ended up, we called the burn to learn, because we had the fire department come in and burn it down, practicing the rest of the way, so that we didn't have to pay costs to have it removed. So all that debris, we reached out to the neighboring landowner or property owner and worked out a deal to sell it to them. So we had all these creative strategies, but we were just happy to lose a little bit of money and not lose our shirts on that one. Yeah. So I think getting these systems in place where you understand what you need to check, and then what your backup is if something does fail, like forced place or some kind of blanket policy, or does your servicer have a blanket policy? So, that's just one small piece. But just remember that the big boys and girls have these rules for a reason. And if you decide to break them, make sure that you understand are prepared for the consequences.
Yeah, right. Exactly. So systems and processes, right? And then stick to them. But again, this goes back to I think the first thing that we talked about, in that mistakes are the best way to learn, because, you knew from your corporate work that, you make sure the insurance is in place, but you go, okay, well, we'll let it slide this time. Doesn't seem so bad. And then force of God, like the house burns down. That's crazy. That's absolutely crazy. That's the worst stroke best timing I've ever heard of. That's horrendous.
Yeah. And then your heart goes out to this borrower too, because he had a sad story that he'd lost his wife, and he had let it lapse because he was paying for her medicine, and he couldn't. And it was at Christmas time, and it was the lights on the Christmas tree that caused it. I mean, this had so many tug at your heartstring moments, but the reality was, he couldn't, he wasn't going to make the payments anymore. So, we worked with him to do a deed in lieu, because, it was cheaper than going through a foreclosure. Yeah. Anyways, but I mean, we learned so many lessons on there, but we remained flexible and fluid, and we worked our way out of it. But it was not a situation I ever wanted to repeat.
No, absolutely. And that's by definition, this kind of psychological flexibility that I talked about with Jamie in our last podcast, that's required to be successful. You can't, and it goes back to what we said about not having too rigid a plan, right? Because I don't know what letter that plan is, but it wasn't plan A, plan B, plan C, or plan D, right? You can't You can't possibly plan for all eventualities. You can't plan for something. Well, you can plan for something burning down, but you don't expect it, right? And the plan that you have for something burning down is making sure you've got insurance in place. So
right, normally that's the case, right? That is normally the case, and that should be the case. And then you should have a backup plan if their insurance lapses, right? Because it can happen even with a servicer. So does the servicer have some kind of blanket policy, or do you have a blanket policy, or do they put you on there automatically? You know, there are ways to solve that, but you know, that was 20 years ago. We didn't have as many choices as we do now. But I still could have said no. That should have been the choice. Let's get that fixed up before, you know, don't feel pressured. So that would bring me to another note that always sticks in my mind of a mistake I made is that pressure, is that being comfortable to say no. And I had bought, we buy notes on land too. And we had a land note that I had said no to just because I didn't like the equity position, didn't like the borrower's situation or their credit. I was a seller finance land note, and I had said no, give it some more seasoning, get it some more equity, and then we'll circle back around. And that seller came back and said, oh, but I'll sell it to you for this amount, really sweetened the pot. Right. And I'm like, oh, that's good. And I thought my investment to value was like at 50% investment to value. And it would have been, except something called 2008 happened. And if you think home prices fell, let me tell you, land prices fell also. So what I thought was in half of the property value ended up being, you know, the property value and then some. So I did get a deed in lieu on that one, but I learned that don't get drunk on yield. If you don't like the deal, you don't like the deal at any price, right? In some cases. And, you know, 0% of a 60% yield is still zero.
Yeah, absolutely. You're gonna, somebody summed it up really well to me when they said return of investment before return on investment.
Yes.
Right. Yeah. And it's absolutely the case. But, you know, you're at 50% ITV. You still get out of it in 2008. That's pretty good going, because not many people got out of a lot of stuff in 2008.
Well, but when I took it back, it wasn't a 50 ITV anymore because property values had dropped,
right? You've been about 100, right?
Yeah. So I actually still own those lots. I haven't taken a loss on them yet because they are going to come back, and they already have, and I will be fine on that. But it's going to take time. That one took time.
That's the magic ingredient, and that was right back to the first point that I made in terms of expectations. Time. I don't expect to turn a note around and make a ton of money in 6 months. It's going to take years in many cases to turn a profit. Like if you're buying a performing note, you're going to see a yield maybe within 30 to 60 days, right? You're going to see actual cash come back out. You're going to see money come back in, and that's lovely. And I think that's something that our investors love. Like we pay our interest to investors on the 25th of every month. So sometimes, like we closed one on Monday this week, he's going to get his first interest payment within a couple of weeks, and he's going to be really, really happy with it. And he's going to go, oh, thank God. It actually works. They do what they say they're going to do, right? And you get the same in the note world when things start performing for you. And that's one of the best things I think about performing notes is the fact that it is fairly instantaneous. But I think the next, you've kind of covered my next point, which was paying too much. Right. But it's subjective. But the thing is, I've seen where somebody's bidding on a note and somebody else came in to bid on the note because they are a real estate investor in that specific market and they just want that house. Right. So what that note is worth to person A is wildly different to what it's worth to person B. Person B can afford to pay a lot more because he's going to renovate that house and he's going to keep it as a rental or he's going to flip it. And it's on the very street that he already owns a couple of houses on. So he's prepared to pay a lot more than the other person. But it's easy to get caught up in a bidding war and say, yeah, but I really want this deal. And it's easy to pay too much, but too much is a subjective term because what something's worth to you in the note game, there's no pricing book that's, renewed every month to say, right, this note is worth this much. It's worth what you're prepared to pay for it, or what somebody else is prepared to pay for it. And that's going to be based on your game plan, what you think of the deal, your tolerance for risk, what money you think you can make out of it. And those thoughts for you are going to be different for somebody else, right? So it's subjective. So I think paying too much, but you covered that quite nicely. And you kind of led into the last one I've got on my list, which I scribbled down while we were talking, so I cheated a bit, is loan servicing. Like we've just started the process of moving all of our private loans that I have on my houses over to a servicer. I was just paying interest direct to my lenders themselves. But a lot of those lenders have gotten caught up in a program that's gone quite wrong in another state, and they're about to lose everything because the guy let property taxes back up and the houses weren't rehabbed and they've all slowly come vacant. And that was really why I decided to move everything to a loan servicer, because they're going to escrow property taxes off me every month, and they're going to check that I've got insurance in place. They've got fourth place insurance products. They've got a loss mitigation department. And the problem that these guys had is they trusted the person selling them the note a bit too much, because that person selling them said they were going to oversee that for them, and they weren't overseeing it. They should have put those with a loan servicer. And that's really what I should have done with all of my borrowers. So that's what we're now doing, to give them that peace of mind. But it's a mistake I see people make all the time. You need a loan servicer because you don't want to have to be dealing with things when they go wrong. You absolutely do need a loan servicer, I think.
I agree with you. And we buy a lot of notes that the seller collects their payments direct from the buyer, and then we'll get it set up so it can be serviced. Number one, your time and energy is more valuable spent somewhere else.
Yes.
And number two, there's just certain laws and regulations that exist that it's better to have that third-party servicer.
Mm-hmm.
And another thing I would suggest to people is if they're buying a note that's already serviced somewhere, just for that peace of mind, if you want to change the servicing, just wait until you've got the first payment or two, because oftentimes if you're buying a note, the buyer-borrower gets confused, and it takes some time to get them back on track. And there's nothing worse buying a note and you were saying holding your breath, and then that payment doesn't come in. So if that continuity is, even though you've got the assignment in the endorsement, the original note, but the buyer's still making their payments to the same servicer for a few months, that makes that transition a lot easier, and you'll sleep better at night. And then maybe you pay the fee if you want to move it to a different servicer for some reason. You want them all in one place, or you like their fees better or something like that. So yeah, servicing is an important piece of all of this. And we all love to hate our servicers. They're not all perfect. They make mistakes too. I still service my servicer. So even though they're supposed to be checking taxes and insurance, I still check taxes and insurance. And spot check it and put it on, I know when they come due, and just calendar it and have it checked on, because I want to make sure they're checking, because nobody watches your money like you do.
Absolutely. Absolutely. And I think that's a great piece of advice as well. Just keep your note with the same servicer. That's one of those kind of little nuggets that people wouldn't necessarily think of, because you think, right, no, I've got a service, I've done the job right, I've got someone that I trust and someone that I want to deal with, so I'm going to just move the note. And it can be a problem. I get the same when we buy a property with a tenant that's in place, and trying to get them to pay their rent to us as opposed to the old person. I've found actually that I don't like buying houses with tenants in now. I tend to factor in the cost of the time and financial cost of having to evict that tenant for non-payment, because it happens about half the time. Because I found a lot of the time, especially in these kind of low to moderate income houses, the only reason that person has stayed in the house is because of the landlord rather than the property. So the landlord has let it fly when they've been a week late with rent, and the landlord doesn't give them any problems because he's not coming to repair the property, right? So they never hear from the landlord. So they've gotten this kind of easy life in that respect. So that's why they've stayed in the house. And then we come in and we say, hey, we're going to fix up the house, we're going to do these repairs, but you've got to pay your rent on time, and this is how you pay it. And they're like, oh God, we don't like that. We'll take this opportunity to move out. So I tend to find that tends to be the case. And I would imagine it's kind of similar. It's for a borrower, it can be scary when you get a letter saying your mortgage has changed hands, because they don't necessarily know what that means. It can strike fear into the heart of a borrower. And I think it's, as an investor, our responsibility to make sure that they're on side with you, and they're not losing sleep as well, because people do. But so what have we got? Expectations, education, being able to pivot on your plan, don't pay too much, and get your loan serviced. And you added in there, which I'm stealing as well, taxes, title, and insurance as a very bare minimum. As a very bare minimum.
Very bare minimum.
And also, I've stolen a few terms that I've written down. Lien lord, I like that. I'm stealing that. Landlord to lien lord. I'm going to write an article. I'm going to create an entire article. Landlord to lien lord.
I'm not the only one to use that term, but it's a fun term.
Well, I heard it from you first, so you can stick a flag in it if you like. I'm British. We stick flags in everything. It's how we got to where we are. At one point, we stuck a flag in America, but then you give it us back. I think the last thing I wanted to talk about was the main attraction to notes, or one of the main attractions to notes, is the fact that you can buy it at a discount. You can buy real estate at a discount. I frequently do. In fact, I have to make it fit my model, because we have to fix the house up and we have to be able to sell it. So there has to be profit margin in it. And I've made the mistake of paying too much for real estate as well as notes. But when I spoke to Brett at Paperstack, he said that at the moment, the biggest selling item, if you like, on their platform are performing notes and reperforming notes. That's what most transactions are. And they're trading at like 95% of unpaid balance, which I think is quite high.
It is quite high.
Yeah. But that's what seems to be what people are paying. And
I think people need to listen to the last point you just made.
Yeah, exactly. Well, I think I have a sneaking suspicion that's because more and more people are getting interested in notes, because more and more people are losing faith in traditional investment markets. So 100%, almost every conversation I have with a prospective investor from my program, they're talking to me because they don't want all their money in stocks and shares. That's the primary reason. You know, we've positioned our marketing to catch people at the point where they're starting to do their research on different asset classes. So that's the interjection point. And when I start having a conversation with them, and without fail, they all say, look, we want something simple that we understand. We want something that pays a good return. And we just don't want all of our money stuck in the stock market because we don't trust the economy, the leadership, whatever it is they don't trust, but they don't trust the whole thing now, basically. And, you know, a lot of them are getting to the age where volatility in the market can be financially devastating because they don't have the horizon to recover from that. You know, you can take a loss if you've got enough time to sit it out, usually. But
like my land notes.
Yeah, exactly. Like your land notes. Absolutely. That's a long-term investment. So I think my sneaking suspicion is the reason that people are paying 95 to 95% for performing notes on Paperstack right now is because there are just a lot of new people coming in and they're happy with the return that they see on that. They don't want to be professional note investors. They're just adding notes to whatever else it is they do. And I think that defines the people I'm speaking to as well. They don't want to become note investing experts, but they do want to get involved in the asset class because it ticks a lot of boxes for them.
Yes.
But what that does mean is that the people that are doing it for a living, like yourself, for example, you're going to be priced out on a lot of notes by these people coming in because they're like, okay, I'm happy with 6-7% return on my money. So I'm prepared to pay this much for it. Whereas you might pay a lot less for that note because you have a different standard of return that you need, and you have a wider understanding of the risk that might be involved with that. So I do think people are maybe paying a little bit too much now, but I think it's really interesting to see that because I've never seen in 10 years people paying that much for even really good quality mortgage notes that are performing or reperforming.
The thing I would caution people is that, first of all, it's okay that the market's like that because it's supply and demand. And so for us, we just position ourselves earlier in the supply chain. Yeah. Because they are not going to go out and market direct to those sellers, or they're not going to buy portfolios of non-performing and change them into reperforming. So you have to get in earlier in the process and then use that to your advantage. It might be an exit strategy where you could sell them off at that. So there's still opportunity there. You just have to decide on where you're going to play in the market. The one thing that I would caution, and when we have a 10-step pricing model, and one of the things that we look at is you've got to look at, is there enough discount that if they paid off tomorrow that you could at least recoup your costs? I've seen people pay up there 100 cents on the dollar. They're not getting points or fees for origination, and they're going to have some costs of acquisition, and then the note pays off. They'd actually end up losing money. So at least make sure there's enough discount to cover that. Make sure that there's enough yield there after your net of acquisition and net of servicing costs each month, that it's a good investment for the risk, right? So make sure you're looking at that. And then you're looking at the time value of money. What is the yield if it does go to maturity? So one of the big things I'm passionate about is teaching people how to use a financial calculator. It doesn't have to be the old HP 12C. You can use any app or 10BII or any kind of amortization app, but you've got to understand the time value of money, because a note might pay off early and it might pay to term. So you've got to understand what that time is, because notes amortize down. So every month some goes to interest and some goes to principal until the balance is zero. Different than a piece of real estate, right? That still has a value at the end of you paying off the mortgage. But when you own a note, eventually goes to zero. So the other thing you've got to be doing is reinvesting your money, because if you don't reinvest your money, then that piece you got back that month, that interest you're earning stops, right? So you got to get it reinvested. That really affects your cash flow too. So never interrupt the power of compounding interest, right? You always need to have it continue and be growing. And so to your point, yeah, it's an interesting time in the market. And we just, after doing it for so many years, go, okay, how do we position ourselves differently? I look at the listing sites, which I really like. There's several of them out there. I look at those as like you're buying a piece of property on the MLS. If you're a wholesaler or a fix and flipper, you don't usually buy your properties on the MLS. You got to get in the chain sooner. You might sell them on the MLS. So just realize that's the market you're in when you're on those listing sites. Yeah,
you're an end user. If you're buying that, you're the ultimate exit strategy for a chain of people before you. So that's the value point you get, and that's not necessarily a bad thing.
It's not.
That might be where you're comfortable. And you're happy with that kind of return. Like again, some of the people that I deal with, they start off thinking, oh, private lending, I'm going to do that because it's profitable. And then they realize that there's a whole bunch of education they need to do with that. And it's actually really quite technical, and they need to make sure that they're not taking undue risk and how they do their due diligence. So they go, actually, that's way too much time and effort for me to put in. I still want the return on the product, which is where I come in, but I don't want to have to become a private lender, as it were. So I think there are a lot of people in the note space the same. They don't want to become a note investor. They just have some notes as part of their portfolio, and they understand roughly what they're looking for. But those listing sites are fantastic for that, provided you've done enough work to ensure that you know what you're looking at, and you know how to sort of assess a collateral file and the big red flags to look out for, and you take account of taxes, title, and lien, and you do the job properly, and you follow some of the golden rules. It's fine.
Yeah, and I have 21 note investing tips that I offer for people as part of our free things on our website, and I know you're going to share a link for that. So that gives you a nice checklist, 21 tips for investing in notes and standard checklists and those sort of things. So like you said, there's all kinds of great resources out there. So we invite people to check those out.
Absolutely. Which kind of let's round up and talk about noteinvestor.com. You've set up a page, noteinvestor.com/David. Yep. So anybody that's listening to this can go to that page and register for access to all of your cool stuff. There's some stuff that's paid for and there's some stuff that's free. The free stuff is incredible value. It's the best value you can get. It's my favorite price. Free. All the prices, that's my absolute favorite one. But you've got,
unless somebody pays you, right?
Yeah, rarely happens. But you've got books, articles, videos, webinars, masterminds. You build people websites for their marketing. You're kind of a one-stop shop. And what I really, really love about it is you're not selling people notes. You're buying notes. You're a note investor, and you're showing people how to do it. But you don't have that inherent conflict of interest. Like I have a bit of conflict of interest when I'm talking about private lending, because I'm then saying, haha, here's my program. It is somewhat of a conflict of interest, and you have to be careful not to be disingenuous when you're in my position like that. But that's the beautiful thing about what it is you do. It is genuinely education. You're a note investor. You've been doing it for decades. You've made some mistakes yourself. You've learned the hard way. You've had some great wins as well. And that's knowledge that you're now passing on to other people for what I have to say is an incredibly reasonable price as well. Just talk about that for a second. Like I noticed on the website, like access to pretty much everything. It's like less than $1,000, right?
That is right. And we actually also have a support mentoring group for $97 a month that allows people to have access to the program. Some people like a monthly approach, or they can do a one-time cost, like you mentioned. The coaching is additional just because Fred, my husband, and I are hands-on with that. So it's got to be worthwhile for everybody. But yeah, we don't come at it, like you said, I appreciate you mentioning that, but really the intent is here to give some people some good, broad knowledge, and if they want to take the next step, they can, but they have a place to start. It's just that is the one beautiful thing about the internet, right? Because we started in this business before the internet. And it's changed our business. For us, it's changed it for the better, because we can reach and access so many more people, and we get a lot of fun out of it. I mean, I'm in my 50s now. No, you can do the math. I've been doing this a while, right? And it's fun to see people get excited about notes and see that carry on. Somebody taught me when I learned this in the 80s. The person who taught me, they've been doing it since the 1950s. So this has been around. I didn't invent it. None of us invented it. It's been around. It's just a way, it's a form of financing. And so it changes over time. We get better at it. But yeah, the internet is a great tool for note investors, because we can learn so much about a note now up front just by doing a little bit of research on the internet. And we can do it from anywhere, right? You can be in the UK. Yeah. We've spent 6 or 7 months down in Guatemala and done it. We've been in Italy. So you can do it from anywhere, and it's a good business. I'm so fortunate that I happened upon it, because I didn't find it on my own, right? I happened upon it being somebody who did title and closing and just new documentation, and I happened upon note investing. And so thank you, universe, for showing it to me, because it's been good.
Well, it seems like you've done very, very well for yourself out of it. And I love the position that you put yourself in as an educator, and you really are serving the community in terms of the investment community, because there are, as with any space where we talk about profits and money, there are plenty of people out there that will take your money who don't really have a quality product to offer. And that's not to point any fingers at anybody, but they exist. But this is what I mean about spending enough time immersing yourself and connecting with people in the game, because you start to learn very, very quickly who's genuine and who isn't, because if you've got a good feel for people, that is. But yeah, brilliant. Listen, Tracy, thank you so much. I'm sorry about the technical issues we had getting started. That's totally my end. I'm going to go and throw my laptop out the window. It's been really, really good having you on. It's been really valuable as well. To summarize, my list was expectations. Don't have too high an expectation in terms of times and return. Get the right level of education and mentoring. Noteinvestor.com is a great place to start, /David, and you get your access there. Don't have too rigid a plan. Don't pay too much. Make sure you get a loan servicer and familiarize yourself with taxes, title, and insurance, and don't let that slide. I think that's some pretty good advice.
I think that's pretty solid. Thanks for having me on the show. I value what you're doing, what you're adding to the community, and so thank you very much.
Perfect. Thanks, Tracy. Take care. All the best.